From New York City, for our viewers worldwide, I'm Katie Greifeld in for Jonathan Farrow. Bloomberg Real Yield starts right now. Coming up, the edge finally comes off of U.S. inflation, and that's followed by a downshift from the Federal Reserve. And that's all as a 2023 recession becomes the consensus. We begin with the big issue, fighting the Fed.
Powell keeps giving the same message.
They still have more work to be done.
He kept pounding away at the market.
They're simply not there yet.
17 of the 19 dots are above 5%.
I do believe him, but the market does not.
The market's calling the Fed's bluff.
Not really listening to the Fed.
The markets are saying, well, we're still not even going to price in a terminal funds rate above 5%.
We can say the dot plot is relevant, but when has the dot plot been right?
The market's saying, look, we've tightened a lot.
We have seen a drop in the CPI.
The consumer is rock solid right now.
Markets, to some degree, are looking for central banks to react as they reacted when economies had gone into recession over the last 2 decades, when inflation wasn't a problem.
They've lowered their GDP to 0.5. That's as close to a recession as they ever get.
The Fed is effectively saying we're really serious, guys.
More than the market ignores the Fed, all that's going to do is force the Fed to keep rates higher for longer.
You fight the Fed on this at your peril.
Joining us now, Brandywine's Tracy, Chen, and Matt Diczok of Merrill and Bank of America Private Bank. And Tracy, the bond market right now is pricing in about 50 basis points of cuts in the second half of next year. And if you rewind and look at what the Fed's new dot plot says, it doesn't say anything about cuts. So who wins here?
Yeah, I think the market has been misinterpreting Fed's message for quite some time. The recent Fed speech is very hawkish on the terminal rate levels and very dovish on the pace of hiking. And I don't think there will be rate cuts next year. And the market has been pricing at least one cut. So I think there will be an adjustment in terms of price going forward, especially on the short end of the rate. So I think there will be a kind of repricing of that, and the market should try to price that out.
Mm-hmm. And Matt, there's a good reason why "don't fight the Fed" is one of the most overused phrases in financial markets. Is there any chance that this time is different?
So there's always a chance that this time is different. We don't like to usually assume that, but there's always the chance. You know, what we're seeing now is a very interesting paradox. And so if the Fed ever says, hey, we might cut at the back end of next year, or that might be necessary, the more they start to talk about something like that happening, the less likely it can become true, right? Because if they start talking about potentially cutting next year if they need to, the market will get ahead of it, financial conditions will ease, it'll make it that much harder to do. Paradoxically, now by saying, hey, we're getting higher, we're staying higher for longer, we don't see rate cuts, labor market's strong, it's not going to soften. By saying all those things, they give the market more credence that they're fighting inflation, they'll get more credibility, and that will actually create the conditions, tighter monetary conditions, tighter financial conditions that might make cuts at the back end of next year a lot more likely than the Fed thinks right now.
You bring up financial conditions, and actually that was the first question to Jerome Powell during Wednesday's presser. He got a question about whether the easing of financial conditions in recent weeks is a problem, and he pretty much brushed that off as short-term moves. But we got a reminder from former Fed Chair Richard Clarida weighing in on that behavior, saying that basically if markets keep easing financial conditions, the restrictive policy loses its bite. So on that note, Matt, at what point do financial conditions easing become a problem for this Fed?
So my sense is the Fed is not happy with how easy financial conditions have been and have gotten. And they're not going to say that directly, but I think that is what Chair Powell is alluding to when he said, hey, we don't look at short-term moves, we want to see a trend. But as we said a couple of times, investors need to mind the gap here. There is a significant gap between what the rates market is saying, obviously deeply inverted yield curves, highly predictive of a recession, all the economic data, leading economic indicators, money supply growth, which has gone negative 2% negative almost, largest negative print in terms of money supply declining over 6 months we've seen since 1959, the history of the data. So certainly a lot of things in the economic side are saying recession, but the labor market's not saying that yet. And credit spreads, for example, are not saying that at all, right? Investment grade credit about 130, high yield about 4.5% approximately. Those are not near recessionary levels at this point. And so at some point you'd have to think they will have to soften more next year as the labor market softens and catches up to the other data.
And Matt, trust me, we're going to get to the different message that the credit markets are sending versus the Treasury market. But let's bring in George Bory now. He is from Allspring. And George, we're talking about what we learned on Wednesday. And one of the things we learned is that Powell isn't backing away from that 2% inflation target, even though there's a lot of daylight between 7% and 2%. How long does it take to close that gap?
Well, we think it's going to take a while. And, as we just mentioned, confidence is critical. And that's clearly, in our impression of what the Fed is trying to maintain, is a hawkish bias to sort of convince the market that it is going to be able to get inflation down to its target. We don't expect it to be a straight line. Next year is going to be a challenge, and sort of divide the sort of the trend into maybe 3/3. The first third going from say 7 down to say about 5%. Will be sort of reasonably achievable and somewhat easy to get to. The next sort of third from say 5 to say 3.5%. That's going to be a challenge. And that's really where sort of the expectations for the middle of next year, we have some questions about. And then that final third, all the way back down to 2, that will really be a test of the Fed's kind of resolve and whether they're willing to sort of pressure the market and really push the economy to those kind of levels. So from our perspective right now, the most important thing that the Fed can do is they need to get Fed funds above the spot rate of inflation. And we're not there yet. Sort of the PCE numbers, and if you look at, say, core CPI, still hovering just below 6%. Fed funds is at 4.5%. Those numbers should cross as we get into 2023. Once that point occurs, the Fed can become a lot much more purposeful, and they can be viewed as kind of ahead of the curve. But we're not there yet. And the Fed has to keep the market's confidence that they're going to get there.
Well, George, let's talk about when those two lines meet. Does that happen when Fed funds is at 5%, or does that happen when Fed funds is maybe closer to 6%?
Yeah, we think it's 5. I think that as, given the sort of the trajectory in inflation, as I mentioned, getting inflation back down towards, into sort of the 5 and sub 5, that is, we think, achievable. And so once that occurs, which we think could happen in the first half of next year, the Fed can be much, much more patient. That messaging doesn't have to be exclusively hawkish. We don't have to have this ongoing game of cat and mouse, and Powell's somewhat dovish one day and then very hawkish the next, and he's sort of toggling back and forth. We'll get, I think, a more balanced kind of message, but until we get to that point, they can't afford to do it because, as we mentioned before, that confidence element is so critical, and he has to preserve confidence. Our view is that, the bond, it was very encouraging yesterday, that the bond market basically held in, that it effectively, stocks were off, bonds were flat. That's actually a pretty good story. And we think that, you're probably getting to the point where you could say the bear market in bonds could be over, simply because the Fed is heading in that direction. Inflation's falling and the Fed is still tightening. Those two sort of dynamics are pretty powerful for a bond investor.
Well, George, that's a big call that we could be at the end of this bear market in bonds. But Tracy, I want to come to you on a big wild card in what the Fed is trying to do with inflation, which, of course, is China, a potential pivot away from COVID-0, a potential reopening of one of the world's biggest economies. What would that mean for U.S. inflation? What would that mean for the Federal Reserve?
Yes, I think China's reopening is faster than anyone expected. I think the decision to fully reopen is almost a forced one because the local government cannot afford to continue the PCR test and all this lockdown anymore. and they can't afford their economy to have a hard landing. So this quickened pace of reopening will create a kind of chaos in the near term. So I think in the near term, we'll see the growth and activity continue to worsen before they get better. So the timeline is really hard to estimate right now. When are we going to see the pickup in activity and the recovery in its economy? So I think right now it partially dependent on the mutation of the virus, whether we're going to see some more detrimental variant of the virus. But at the same time, I think we are closer to the end of the tunnel. So I think it's a double-edged sword. On one hand, you will see a pickup in recovery and then potentially increased demand for global commodity, and that will actually increase the risk of inflation. And I think that's definitely a wild card. But at the same time, the growth will be hard to estimate at this point in terms of timing, the timing of the recovery. So in the near term, we'll see more disinflation or deflation from China.
A double-edged sword, one of many cross currents hitting fixed income of all stripes. We're going to keep talking about it next. I'm thrilled to say George Bory, Tracy Chen, and Matt Diczok, everyone is sticking with us. Up next, it's the auction block. JP Morgan makes a move to top the tables. That's next. This is Real Yield on Bloomberg. I'm Katie Greifeld. This is Bloomberg Real Yield. It's time now for the auction block, where the global debt market saw roughly 140 fundraising transactions, including bonds, loans, and asset-backed securities worth at least $75 billion pulled in 2022. Over in the U.S., bond offerings have just about dried up in December. Volume is set to finish down by about 16% from 2021. JP Morgan, though, did sell $3 billion early this week to narrowly take the lead in the Bloomberg league tables for high-grade sales in 2022. We did catch up with notable investor Bruce Richards from Marathon, who calls for a recession in the second half of next year. Now, that slowdown, coupled with an earnings recession, will start downgrades and a default cycle.
We think we'll have a cumulative default rate of 10%. That's enormous. The reason why that's enormous is because the high yield market used to be a $1.7 trillion market. Today it's a $5 trillion market. And so 10% of that is a whoppingly large number. The good news is 90% of the credits won't default. And for us to pick a quality portfolio of BB credits, BB loans, structured credit that yields 8, 9, 10% that won't default. At the same time, you have this big default cycle picking up, and that allows you to play it in multiple different ways.
Still with us, George Bory, Tracy Chen, and Matt Diczok. And Tracy, Bruce picks up on an interesting thing about this cycle, this potential downturn, is that we haven't really seen a pickup in defaults. And obviously, he thinks that's going to change. But where do you fall on that? Do we see more defaults in 2023?
Yeah, I think this cycle is not a normal cycle, right? So I think if you use the old playbook, it might not work this time. I think in terms of default, I think it will go higher definitely next year. But how high it can go, it really depends on the interest rate sensitivity of the credit assets. I think in this cycle, the interest sensitivity is a little bit lower than before. For example, the mortgage owners, their existing mortgage, the average existing mortgage coupon that they locked in is about 3.5%. So their sensitivity to rate increase is a little lower, and this applies to corporate bond market as well. So both the balance sheet of both consumer and corporations are much better than the ones they have in the global financial crisis. So with that being said, I think the default cycle might be a little benign this time around, but I'm more worried about the financial stability because the pace of hiking in this cycle is unprecedented. We haven't seen that in the past 40 years. So I think something is going to break. We have already seen housing that has been slowing down quite drastically, and the Bitcoin market has some turmoil as well. So what will be the next shoe to drop. I think the financial market will see some fireworks there next year.
Well, some turmoil in the Bitcoin market might be an understatement. But as we look ahead to next year, we had JP Morgan's Bob Michael looking for opportunities, saying that our best idea is to use every backup in yields to add high quality duration to portfolios. Investment grade corporate bonds top our list, while government bonds now offer the highest real yield since the financial crisis. And George, I want to know, is that your best idea as well, high grade bonds?
So the notion of positive real yield is really our best idea, and you can scale positive real yields at different points along the rating spectrum as well as the yield curve. And just going back to what you just mentioned around sort of corporates and corporate risk, there is a fair bit of kind of risk embedded in the corporate system, but it really comes down to sort of balance sheet structure more than anything else. And so that whole notion that maybe you'll get 10% cumulative default rates, that does grab a lot of attention. That's probably a pretty good messaging and a starting point. But really, where do those defaults ultimately manifest themselves is going to come down to who is not able to either absorb or hedge out the sudden sharp increase in interest rates. As Tracy mentioned, if you've financed yourself with low-cost debt that doesn't mature for a long period of time, you're in a very good position right now. If you borrowed a whole load of bank debt that is sort of rapidly repricing and you haven't hedged it and you can't pass through those interest costs, well, now we've got a meaningful problem. So we've taken a very narrow approach as to where these may manifest themselves, and the loan market for us is is definitely sort of the spot where we see the most amount of pressure. We're most cautious. We've been reducing our allocation there. Investment grade looks pretty good. Most of high yield looks pretty good. And to go back to Tracy's point, asset-backed and securitization arguably looks the best.
Well, Matt, what you expect out of defaults largely expects whether you have a view for a recession. And like you touched on before the break, if you look at what stocks are pricing, if you look at what treasuries are pricing, it looks pretty close to a recession. But then you look at spreads, investment grade and high yield, no such concern. What changes in 2023? Are spreads right, or are all the other asset classes going to win out here?
Yes, this is a very interesting conundrum, and I think what explains it is the fact that the labor market is still quite strong for now. So it's more of a recession delayed but not denied. So the recession, which people have been expecting sooner, is probably later 2023, even early 2024, until you actually start to see job losses, until you start to see the unemployment rate tick up, until you really see the consumer starting to be squeezed. Maybe you don't need to see those recessionary levels yet. But from our view, the more complex the macro picture, the more disconnected the yield curve and leading economic indicators are from investment grade and high yield credit spreads, makes your portfolio decisions somewhat easier. You just don't want to stick your neck out too much on a number of asset classes. You want to be broadly diversified. You want to make sure you've got treasuries, agency-backed mortgage backs. Do not be too overweight spread product. But we do agree that over longer periods of time, investment-grade corporates, high-quality fixed income is going to do quite well. Picking up on a point George made, we agree 100%. These are some of the best real yields we have seen since the financial crisis. This was an opportune time to go overweight fixed income. We went overweight fixed income 3 or 4 months ago. We want to make sure clients stay fully invested in fixed income and not put all the money in T-bills. We're seeing a lot of activity in the short end, but be out the curve, close to your strategic duration target fixed income, and be overweight fixed income here.
Well, it's funny that you mentioned T-bills, because one of the only things that's really worked this year is cash. And actually, Romaine Bostic and I caught up with Stephen Bird. He's the Aberdeen CEO earlier this week on that topic.
Cash has been a very good diversifier. It's been the only asset class where you've been getting a sure return in 2022. So you've got to, any diversified investor has got to have a portion in cash, because nobody knows what's going to happen. So when you don't know what's going to happen, you need to look at balance in your portfolio. So cash, there is a short-term benefit because you're getting a risk-free rate today, which is very, very attractive. But we also think that you've got to be positioning for not just today, but tomorrow. And that's where our investors are saying, what's going to happen next?
Now, Stephen Bird also said that his position in cash has been increasing as rates have risen. And George, do you agree with that you should be in cash at this moment, at least at some level?
Yeah, liquidity is really important in this market, and we've seen that sort of become more of a factor as the year has unfolded. You know, the sort of the hurdle rate's 4.5%. If I know I can buy, sort of front end yields at roughly right around that level, 4.5 to 5, everything else has to beat that. So there's a good argument for maintaining a certain amount of cash. We have had relatively high cash positions in our portfolio, both from a liquidity management perspective, but also as from a tactical positioning perspective. We're not giving up on that just yet. But when we look at the shape of the curve and we look at sort of, kind of optimal risk return targets, the 2 and 3 year part of the curve look very attractive across a variety of segments of the market. That includes, as I mentioned, some corporates, some structured products, some mortgages, that sort of position from both kind of a yield and a curve positioning standpoint to us looks very, very attractive. And the combination of those two gives you quite a bit of income, a lot of carry, and really tries to sort of position that yield, that very generous yield, relative to sort of where volatility is today.
George Bory, Tracy Chen, and Matt Diczok, everyone is sticking with us. And still ahead, it's the final spread. The week ahead, major central bank decisions continue, plus a host of U.S. data. That's next. This is Real Yield on Bloomberg. I'm Katie Greifeld. This is Bloomberg Real Yield, and it's time now for the final spread. The week ahead, coming up, we have the BOJ rate decision on Tuesday, plus a slew of U.S. economic data that includes GDP, housing, spending, durable goods, and jobs. It's time now for the rapid fire round. 3 questions, 3 quick answers. Tracy, I'm coming straight to you. Does the Fed cut rates next year?
I don't think so.
George?
No.
Matt?
Nope.
Tracy, have we seen the peak in 10-year Treasury yields?
I think so, yes.
George?
Yes, definitely.
Matt?
Yes, we have.
10 seconds left. Do we see 100 or 200 basis points first on IG spreads, Tracy?
200.
Matt?
100, but it'll be close.
George?
Yeah, we may touch 200.
George, Tracy, and Matt, thank you both so much. From New York, this is Bloomberg.